Hey guys, welcome back to another video. Today we're going to be talking about a common succession planning question I get from clients that are thinking about selling their business and the real estate that they operate that business from. So, what do I sell first? My business or the real estate? Because those are two separate transactions. With the business, you're working with a business broker, an investment banker, and then your real estate property requires a real estate agent, and so that's a separate sale process. So, what do I do? What do I sell first? Well, ultimately, the answer depends on your timelines. So, if you have a desire to take advantage of the strong market gains in the property or in real estate market today, but you want to hold on to the business and continue to work in the company for the next 5 years, then ultimately you would enter into a long term market lease rate with the buyer of that property and would continue to operate the business. And in that instance, there is no material impact to your exit value because it's so far away. But if you're thinking about selling your business and your real estate within the same time frame, then ultimately my recommendation is to sell the business first, address that sale, and then address the real estate sale separately. And the reason why is, if you decide to sell the property first and you pick the wrong buyer, that may detrimentally impact the value of the business sale. Whereas if you sell the business to someone that maybe doesn't want the real estate, then you always have available buyers on the real estate side that are willing to pay market rates for your market lease rate. So here's why it's really important to address the business sale first. So when we think about business sale value and maximizing the value of your business, I simplify it to two buckets. The first is ensuring that there's a large pool of existing buyers that are interested in your company. And then two, ensuring that the transition risk that buyer is stepping into by buying the company from you and transitioning it is low. Because a high transition risk with limited amount of buyers results in low interest in the business and ultimately a discount to the valuation. But if you have a lot of potential buyers that may have different options that they can work with, and there's a low transition risk, then ultimately the business trades for a higher multiple on the cash flow. So when buyers are looking at a business that has both the real estate and the business available for sale, there's really three options. The first is they buy the real estate with the business. The second is they lease the real estate from the seller at a market rate for a 5 + 5 year term usually. And then the third is they may even have an existing business within the same space and they move the acquired business into their existing facility and realize the cost synergies. And typically they're willing to pay a premium if they can move that property and the operations into their facility as well. So these are the common options available when you go to sell the business first. Now, in a scenario where you choose to sell the property first, well, options number 1 and 3 are eliminated. Number 1, instead of the buyers that are interested in buying both real estate and businesses would be not interested in your company because you've already sold the property. And then number 3, strategic buyers that may have been able to take advantage of cost synergies are unable to realize those synergies because now they have to step into a market lease with a new landlord that is not the seller of the business. And unless they break that market lease, which is a cost either to the seller in the lower valuation of the business or a cost to the buyer, ultimately they're unable to realize the same synergies and therefore will pay less for the business. So by selling the property first, you're reducing the amount of options that buyers have available to transition that company, which limits the value of the business. And then the last point over here is, in most instances, when a property gets sold first, the investor enters into a short-term market lease with the seller of that property because obviously they want the optionality of, hey, I could take that property and either go find someone else to lease it to, or I could increase the rates sooner for that property to increase my cap rate and obviously the value of the business, the value of the property. So usually when we get involved with situations where the property has been sold first, the business faces a short-term lease scenario. And when there are 2 to 3 years left on a lease, buyers typically will pay less for the business because of the transition risk. There's no option to renew. There's the potential increase in the market rents of that business, which limits the cash flow and the future cash flow of that business, and therefore the value of that business. So in most instances, if the seller has sold the property first, they're facing a potential rent hike in the next 2 to 3 years, and that ultimately limits the business value first. Whereas on the flip side, if you address the business value first, you sell the business, and then you go to the open market and sell the lease that you've negotiated with that business buyer to a third-party investor, you can quickly monetize that property and also address the value of the business. So that's why we always recommend selling the business first. And so let me give you some examples of both scenarios just so that you can kind of see how it plays out. So, our firm, we sell, 10 to 12 companies a year. And so we oftentimes come across both situations. So selling the business first is what we usually recommend. And it's usually a situation where, the seller is planning on selling. We get involved. It takes about 12 months to sell the company first. And then afterwards, once they sold the business, they can address the real estate sale 6 to 12 months afterwards. So in the first example here, we worked with a manufacturer that owned a 70,000 square foot building, and they decided to sell the business first. We found a strategic buyer that ultimately wanted the employees, the contracts, the equipment, and they were 15-minute drive away from the facility. So within 6 months' time, they moved all of the equipment, all of the people into their facility and left that facility vacant. The seller then was able to take that vacant facility, put it on the market, and get a premium by selling the property to a third-party investor. Now, the opposite is, imagine they tried to sell the property first. Well, now it would have been difficult to convince the strategic buyer to quickly move that business into their facility, because probably the lease would have been longer than 6 months. It probably would have been a 2 or 3 year lease. So they wouldn't have realized the same cost savings and wouldn't have paid the premium that they paid. So that was a really good situation where finding a perfect strategic buyer to move the business quickly out of the facility resulted in maximizing the sale of both the business and the real estate within 18 months. Now, a separate situation is where we sold the service company to an investor group. And usually financial investors don't want to buy the real estate. So they ultimately entered into a 5+5 year market lease for both properties. And we closed the transaction within 10 months. With that 5-year market lease, the seller was able to take both of the buildings, go to the open market, and find a financial investor on the real estate side that would buy the 2 buildings and monetize the value of the buildings. Now, thankfully, we were there to advise the seller to say, hey, listen, you need to make sure that you're entering into a market lease, right, with gradual annual incremental step-ups in the base rent, so that an investor would not buy a below market rent agreement, but rather a market rent agreement, so that they'd pay you fair market value for the real estate when you went to sell it after the business. So key condition is really important when you're selling the business, that you want to enter into a market lease rate with that business buyer, so that when you sell the business separately, that real estate buyer is going to pay you fair market value for obviously the income that you're getting from the tenant. And then the third situation here is there was another manufacturer we work with who we sold to a strategic buyer. But in this instance, the strategic buyer was growing very, very fast. They had about 50,000 square feet in their existing facility that they maxed out. And what they really wanted was a strategic buy with real estate that they could buy and actually move into and grow into that existing space. So our client, the seller, had existing space within their facility. They were within the same sector. And so the buyer paid a premium so that they could buy that business and also get access to that excess room so they can move some of their operations into our client's facility. So that was another situation where, by having the optionality of saying, hey, I haven't sold the real estate yet, how about you buy it as well? The strategic buyer paid a premium above market value so that they could lock in that excess space. So these are situations where addressing the business sale first really drove a lot of value. Now, we worked on the flip side with a client where, again, it was a manufacturing entity. They took advantage of strong market increases in value, but unfortunately, they sold that property when we weren't there, and they sold it on a 2-year lease agreement with no renewal option. And the investor that bought the property had in mind that they were going to take over that property after the 2 years, and expected that this business vacate the property within 2 years and find another place to operate from. Well, the challenge now is that as you go to market, you have 2 years left on your existing space. You're trying to sell the business. It's a very high transition risk scenario, which, as we said, limits the value of the business. So in this scenario, because there was only 2 years left and there was a clock on the transition, Financial investors were spooked by the transition and found it too risky to even consider bidding for the company. And strategic investors who would have paid a premium in a situation where they didn't see this clock on the deal actually took advantage of the seller and forced the seller to accept a lower offer because they knew, hey, listen, this seller has to do a deal within the next 2 years. And ultimately, the clock wound down to about a year left on the lease, and the seller felt the pressure to accept a low below market bid and ultimately sold out for probably 30 to 40% less than what they would have received in the open market for the business if they sold the real estate afterwards. So this is a situation where they didn't address the business sale first. They sold the real estate. They entered into a short-term lease, which ultimately, as we addressed before, increases the transition risk, limits the number of buyers available, and that hurt the business value for the client. So hopefully you found the video helpful. If you do have any questions, or maybe you're in a situation where you're thinking something along these lines, please reach out to me over LinkedIn, or you can reach out to me over my website at Robley Capital. And as well, if you're thinking about buying or selling businesses in the Canadian marketplace, I'm always open to connect and meet new people. So please reach out, and happy to have a conversation. Thank you guys so much, and have a great day.